Hey everyone, the Federal Reserve meets next week and presumably they'll reduce the overnight interest rate. This is the big event we've all been waiting for, and although we don't know whether the reduction will be by 25 or 50 basis points, it'll be a move in the right direction. In his commentary at the Jackson Hole meeting a couple weeks ago, Chairman Powell reiterated that the Fed is shifting its emphasis from focusing primarily on inflation reduction to a more balanced position, placing additional emphasis on the employment market. The Fed's strategic shift reflects the rising unemployment rate, which is skating along the edge of the Som-Rule recession indicator, and the Bureau of Labor Statistics' recent release of the preliminary estimated job revisions between April 2023 and March 2024. Every year in the third quarter, the BLS releases its preliminary estimate of jobs revisions, and this year's number is bigger than normal. At 818,000 jobs, it's the biggest downward revision since 2009. But it's important to remember that these revisions will be refined and officially released in February 2025. So for now, we officially added 2.9 million jobs between April 2023 and March 2024. But when the revisions are enacted in 5 months, the official job creation during that time will be reduced to about 2.1 million jobs. One of the other big news stories in recent weeks has been the rise in the unemployment rate and its flirtation with the tipping point of the Som-Rule. Many believe that this and the significant preliminary downward revision of the job creation numbers are a sign that the U.S. economy may be going into a recession. But let me give you some context to consider regarding these data points. First, while the unemployment rate has been trending upward over the course of the last 15 months, that has been by design. For all of 2022 and much of 2023, the employment market was overheating. The unemployment rate was in the mid 3% range, basically at a 50-year low, and that was driving wage growth of about 5.5%. That was part of the inflation problem. Wages were rising too fast. So while the unemployment rate is about 80 basis points higher than it was a year ago, it's still well below the 20-year average of 5.8%. In addition, looking at specific subsegments, the unemployment rate of people between 25 and 54 years old is just 3.6%. And the labor force participation rate of that group is 84%, its highest level since early 2001. For people 55 and older, the unemployment rate is 3.1%, also well below the 20-year average of 4.3%. As for the Som-Rule, we need to put that in context too. It was never intended to be so precise as to ferret out a recession when it's sitting right on the magic number of 50. Claudia Sahm, the inventor of the rule, indicated that even though we're right on the edge of activating the guidelines she created, we're not in a recession. She went on to say that although we're close to a recession, the Fed still has a lot of maneuvering room with interest rates, and by lowering rates, we can avoid a recession. With regard to the other well-publicized employment number, the BLS's preliminary revision, we have to remember that they do a revision every year, and even if you take 800,000 jobs out of that 1-year span, we still added 2.1 million jobs. That's about on par with the average number of jobs created each year between 2011 and 2019. So even though the employment market is softening, we have to remember that it's moving from being overheated to a more normal state. And this is on target with the Federal Reserve's plan to control inflation by slowing the economy. By cutting rates in September and possibly again in November and December, the Federal Reserve can level off the employment market and mitigate the risk of a recession, bringing the economy in for a soft landing. Now, for commercial real estate, we remain on a positive trend. Unemployment may creep up in the coming months, but it's still well below the long-term average. Job creation could slow a bit, but we're still on track to add about 2 million jobs this year, which is a solid number. Wage growth is back under control, but it's still at a healthy 3 to 4% range. And together, those metrics suggest modest but healthy retail sales growth that will support both retail and industrial real estate. In addition, if the employment market aligns with expectations, it will drive steady household formations that bolster demand for both apartments and self-storage. Barring a significant economic or geopolitical disruption, the outlook remains positive for commercial real estate investors who keep their eyes on the horizon.